Welcome to the second episode on mortgages with James Witt. Today we're going to be covering all things about mortgages and retirement and how to retire early and best use your mortgage to achieve that. So thanks, James, for staying for another episode.
Pleasure.
So whether you're sort of a seasoned property investor, high net worth individual, or just a normal person on the street, do you think it's really important to get that mortgage paid before retirement?
I think it depends on your circumstances, and I think that's where you need to talk through that in depth with your financial planner. If you've got a buy-to-let property, you don't need to guarantee that mortgage is paid off. You can just keep rolling that through to retirement forever and a day. If it's a residential property that you're living in and you plan for that to be your final home and never to move out of that property, then yes, you want to be looking to have that mortgage paid off completely. Now, whether that's to be paid off completely through having a mortgage term that fits that date, potentially, but there are obviously lots of other things that can happen in people's lives, whether they're getting inheritance or payouts from businesses or selling a business or anything like that, where that can also be ring-fenced for, okay, I've got that amount of debt and that can be paid off. But yes, if you're planning to stay in your own residential property and you want that to, and you know when you want to stop working, you do need to have a plan of how that's paid off in full.
What are the repayment strategies you could use, and what would you say is the best one?
I think it depends on how your income's structured. I think if you're 100% salaried and you're not planning to receive any money from Uncle Bob in Birmingham who may die, that you want to have a repayment mortgage that is going to guarantee that debt is going to be paid off by a certain date. And I've been quite a fan of extending that mortgage term a little bit to bring down that committed monthly payment. So then looking at overpaying to bring it down faster is a possibility. If you're someone that has a variable form of income where you might get a salary, but you might also get a quarterly bonus, a quarterly commission, an annual bonus, or you might get shares that vest over a period of time, then again have that slightly longer mortgage term. But in discussions with your financial planner, make overpayments on that mortgage that kind of suit your needs. So having a mortgage that is more closely structured to how your income is structured.
I've also seen options where clients have got a lump sum, let's say, from their employer on retirement. That can be used to think, well, that will go against it. But some clients, when we do the maths, it works out better that they have their mortgage on a repayment basis, but for early over repayment, we pay into their pension to get all the tax relief, and then we can use their pension lump sum again to overpay the mortgage. Yeah,
I mean, of course, the longer you've got that mortgage for and the longer that mortgage balance remains higher, the more in interest you're going to pay over the life of that. But I think that's where, if you're engaging with a financial planner, you can kind of run through the numbers to work out what gives you the biggest, bang for your buck. I think, I've seen on your Instagram stories that, you'll show that how making just a smallish regular overpayment over the life of your mortgage can have that mortgage paid off years earlier, which is great. And I think if you're just banking on your salaried income and you want it paid off by a certain time, setting up that overpayment is a great way of bringing that down sooner.
And it's happening. There's no element of chance that the stock market might crash or boom during that time.
Yeah, or that income doesn't come to fruition. You get written out of a will, so you don't get any inheritance, or something else happens. Having that mortgage on a repayment or setting a repayment with a longer term and setting up that overpayment is a great way of guaranteeing when it's going to be paid off by.
And is there a perfect time in the year or in your mortgage year to make an overpayment?
No. Lenders calculate interest daily. So obviously if you can overpay monthly, that's great. But if your income, we might have some people like the city that get 100% bonuses relative to their salary. So the salaries can be a bit smaller and the bonuses can be quite large. It wouldn't suit them to have that regular overpayment because their monthly income isn't that large. So yes, it would be best to be paying that off on a monthly basis with a direct debit. But for them people, it kind of suits them better that when they get that bonus come in, that's when they make their large lump sum overpayment to bring the balance down.
And it's worth saying as well, isn't it, that you can't just pay willy-nilly. what you want without incurring penalties? Like, what are the general rules of thumb about what you can overpay?
When you're on a tracker, certain trackers or certain lenders, you are able to overpay as much as you want when you want. But you would only be on a tracker for a reason, I believe, because their rates are normally higher. You've got more, it can vary, and you've got that stress of looking, what's the Bank of England doing this time around? Oh, they were going to cut, they're not. What's the inflation figures?
It'll be the first time you're looking at the Monetary Policy Committee meeting
Exactly. It's not riveting. So most people will be on fixed rates, whether it's a 2 or whether it's a 5. And for the worst of the lenders, your overpayment allowance will be 10% of your mortgage balance every year, calendar year or every anniversary.
So is it the balance that you currently have or the amount when you took it out?
Every lender's a little bit different. The worst would be what your current balance is, because that's lower. Some lenders, it's 10% of your original amount borrowed nationwide. NatWest have a 20% overpayment facility, and so do a couple of others. So you have, in general, you have a lot of flexibility.
And where do you find that? You just call them up, or where do you find this information?
Yeah, it will be in your mortgage offer. In the latter pages where it talks about flexible features, giving you an overpayment allowance. But I'm pretty sure, I can't think of a lender that doesn't have a overpayment allowance when you're on a fixed rate, and the worst is 10% of your mortgage balance. So you can set up a direct debit and leave it running. If you wanted to make that kind of bigger overpayment, more than 10%, where you have got a lump sum from an employer payout, inheritance, a gift, or something like that, you'll either need to wait till the end of your fixed rate. Okay, so maybe considering tying that money up for a period of time to get a rate, or if you know that's coming and your deal's coming to an end, maybe consider going onto a tracker. If you've got a 300 grand mortgage but you know you've got 150 grand coming in 6 months, maybe go on a tracker for a period of time to allow you to make that overpayment, to bring it down.
And then lastly, some mortgage mistakes can be really costly, and the more costly these mistakes are, the more they're going to, mean you don't pay off early. What kind of mistakes do you see? Maybe not often, hopefully, but what do you see that people are making before they get in touch with you that we could perhaps avoid?
Leaving it to the last minute, I think, for some people, and different market circumstances, it can be very different. If mortgage rates are coming down over a trend over the year, if people leave it to the last minute, great, they've not lost out on anything.
They got lucky.
They got lucky.
Than anything.
But as we know, a couple of years ago, mortgage rates were flying. And if you had a good proactive mortgage broker reserving a deal for you 6-7 months in advance, like me, most of the time I like to be, we might have reserved a 4% deal at that point in time, which would have seen as being not a very good rate, because it would have been the highest it's been at that time, and people are like, oh my god, I can't accept that. If you left it longer, it was 6%, 6.5% in some cases on a 2-year fix. So that's where you do sometimes see these kind of mistakes where people have just left it to the last minute. And also they've left it to the last minute and they want to do something. They want to remortgage from one lender to another, but they've only got a couple of weeks. You need to give yourself a couple of months to go through a mortgage application process and deal with the solicitors afterwards to get that set. And so some people end up sitting on the standard variable rate because, which will be expensive because it's 8 or 9%. They're the kind of common mistakes, is not having your ducks lined up early enough.
Yeah, being ready.
Yeah.
Perfect. Well, thank you very much, James.
Pleasure.